Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Thursday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, today we're going to go over the overall portfolio, how it's been performing by the metrics, our buying power, the individual holdings and how they are performing, as well as my watch list. I'm gonna get McDonald's and Pepsi off of there. Sometimes I just like checking in on stocks. Our watch list and what price I'd buy it at. So jumping right in for today, we are sitting at a value of $53,749.12. Apparently the market fluctuated, even though it's closed. Total today, we are up around $300 with a 0.62% return for today. That 1 week mark, we're up $849.99 with a 1.6% return. That 1 month mark, we are up $340.50, a 0.64% return this month. Then that 3 month mark, we are up $314.74 with a 0.6% return. Then YTD year to date, we are up $3,914.50, a 7.5% return. And then that 1 year mark, we are up $6,402.62, 13.5% this year. And then all time since I started, and I think it was like April 2018, we are up $18,407.53 with a 52% rate of return all time. Buying power is 91.29. I'm going to let that sit for a while, guys. I have a dividend from T. Rowe Price coming in. And of course, that Altria dividend, Coca-Cola, and Realty Income will all be paying me. And then after all those are done hitting the account next month, I'll have a little over $500, and I'll be able to buy maybe a couple shares of Visa if I like the price. I could buy nearly 10 shares of Realty Income, so I have possibilities. I have options with that amount of dividend income. So, jumping into the portfolio, starting off with Realty Income, the monthly dividend payer, sitting at 5302, 170 shares, $9,000 worth of market value. Average cost is 6503. Around 17% of the portfolio is in Realty Income. Today we're down $13.60. Total we're down a little over $2,000 with a near 19% loss. So this is a very good place to put my money. The lower the stock is, the higher it can rise. So sitting at an average cost of 65, I could lower my average cost quite a bit here by over $10 a share. And that dividend income is monthly, so every single month I do get paid around $44, which is great. And that monthly income has actually grown. So they do small incremental increases. They're not huge, but they do add up over time. And I love this stock because it makes me feel like a landlord without all the headaches. They pick the tenants. They make sure they're investment grade tenants. They have a triple net lease, which means that they have no liability when it comes to the property, the upkeep. It's all on the tenant. They just collect the rent, and I love that business model. So I want to own more Realty Income. This is one of those stocks that retirees own because it's steady Eddie income, and it's slow growing, but it's consistent. So I would not mind adding a little bit more to Realty Income, ticker symbol O. Next, we've got Coca-Cola, one of my personal favorites, sitting at $62.15 with 15 shares, a little over $930 worth of market value. Average cost is right around $60 per share. 1.74% of the portfolio is in Coca-Cola. Today, we are down $7. Total, we're up $24 with a 2.5% return. So not up big on Coca-Cola. Still within my buying range. I'd probably make the cutoff at like $65 to $67. So I would buy it at these prices, and I would happily use my dividends to reinvest. Then we've got Altria. Now it's sitting at $45.43. We have 320 shares, $14,500 of market value. Average cost is right around $47.30 per share. 27% of the portfolio is in Altria. Today we're up $200. Total we're only down $590 with about a 4% loss. This has been all the way up to like 10 or 12%, so it's up from the lowest point, and I'm happy with the dividend income that it brings in. Guys, this brings in over $300 every single quarter, and that is good passive income for me. It allows me to be consistent with the dividend reinvestment. I can buy a share of Visa or Apple whenever I want. Eventually, I'll be able to buy a share of Berkshire Class B stock, but that will be in the future. But this is a dividend king, and I'm just going to hold off on investing in it as of right now, simply because it is a pretty big position, and I think there's nothing wrong with it. The growth is okay, but I would rather put more money into a lower paying month to even out my dividend income, as well as put it in a stock that grows the dividend faster, like a Visa, or if it was at a good price, AbbVie. So I just want to put my money into a little bit of a higher growth play, and I'd rather put it into Coca-Cola and build up that position. I just feel like I have a little bit too much money in Altria, so I don't want to be adding, even though I could cost on average a little bit. Then we got Apple at 209. See, I figured the news would start to die down. I have one share. Market value is at 209.30. 132.66 is that average cost. About 0.4% of the portfolio is in Apple. Today we're down nearly $5. Total, we're still up $76 with a 57% return. So guys, Apple blew up. I can show you within the past, like, what week? I'll go month. Up $17. This was that AI announcement. And then I figured it would fall back down to earth. I don't know if it's going to drop down low enough for me to buy it, because that's a huge drop. That's like a meteoric drop there. But I do want Apple to be the single biggest position, and it will take a while because I'm going to have to wait patiently for this quality company to go on sale. Next, we got AbbVie at 170.185. We have 95 shares, $16,300 of market value. Average cost is $95.20. 30% of the portfolio is in AbbVie. Excuse me, getting a drink there. 46.55. We are up today around 0.3%. Total, we're up $7,200 with an 80% return. Guys, keep in mind, I bought these shares. It says they're at $95. I have another, like, tranche or another big buy at $88. So I put, I'm up $7,000. So I put about, say, 9 in, and I'm up 7. So that's a really great return. And I'm just gonna let this this wonderful garden grow. A lot of investors will cut their gains and put money in their losers. And by Peter Lynch standards, by Peter Lynch rules, I'm not doing that. So I'm gonna let my garden grow. I'm gonna let it grow as long as it can. And if AbbVie ever cuts the dividend, if they cut it by a big, if they do a big drop in the dividend payment, and something like Starbucks, or even like Procter & Gamble, or I was looking at like Costco, if some other company that I feel is high quality will pay me a dividend that is near my dividend income, that has a similar like growth rate and history, I will switch it out. But until then, I'm going to let AbbVie grow. Then we got Visa at 277.15, one share. Of course, our market value is going to reflect the stock price. Average cost is 268.29. I'd still buy it here just to add a couple more shares. 0.52% of the portfolio is in Visa. Today we're up $3.50. Total, we're up $8 with a 3% return. Guys, I want Visa to be the second biggest position, and just like Apple, it's a little bit above, well, Apple's way above, but this is a little bit above my average cost, and I'd still purchase it here. And then we got Google at 177. I'm up $36 on my 3 shares, but my average cost is 165, so I'm up about $12 per share here. So I've got 3 shares of Google at $532.80 for market value. Average cost is right around $165. 1% of the portfolios in Google. Today we're up $3. Total, we're up 36 with a 7% return on Google. So guys, when it comes to the overall portfolio, I want it to go Apple, Visa, Coca-Cola, Google, and then Berkshire. And those, Google and Berkshire, can switch. It wouldn't surprise me if they did, because they're both growth companies. But I do want I do want Alphabet, or Google, to be a pretty big position in the portfolio. And then, of course, guys, to end it out, we have T. Rowe Price at 118.28. 100 shares, $11,800 of market value. Average cost is right around $110 per share, so up a little bit here. 22% of the portfolio is in T. Rowe Price. Today we're up $71. Total, we're up $855 with a near 8% return here on T. Rowe Price, and a dividend coming in near the end of the month of $124. So that will boost my dividend income for this month. And guys, if you've watched any of the videos, you know, like I'm holding on to T Rowe for the long term. Like in 2021, a few years ago, it was up to $220 a share. So at my average cost, I have near $100, $110 upside. So I could double my money here. This $11,000 position could turn to like a little over 22K plus dividends. So I'm gonna hold this for the long term. One of the things that I do love about T. Rowe Price, this kind of could be a good, could be a bad thing, but I see it as a positive. Some people freak out when, say, like interest rates change, T. Rowe Price dropped a bunch. Not a big deal for me. This is just, in my mind, this and oil have kind of the same economic characteristics. So like when interest rates go up, T. Rowe Price is going to drop. A lot of stocks actually did, but financial stocks like insurance, banks actually went up. But interest rates affect different companies in different ways. When it comes to like financial stocks, like investment firms like T. Rowe Price, probably BlackRock, Fidelity, Vanguard, like a lot of people went out of funds and individual stocks and put their money into treasury bonds, which then stocks like T. Rowe Price will go down. Same thing with oil. When oil prices are up and oil companies are printing money, people love them. They fly to the moon. But when oil prices were negative and people were like trying to get rid of barrels of oil for like $5 for a barrel or whatever it was when it was crazy negative, the stock went from $30. Now I think it's like at 120. So you could like nearly 5x your money on oil stocks. And I think that this is if you can identify it, the best competitive advantage that you can have when it comes to investing is to be able to differentiate a bad company from a bad story. There's a difference. So oil had a bad story. Were they bad companies? No. They still had money on the balance sheet to pay the dividend and remain profitable. And now, if you held through that, you're on the other side and you're at massive gains, massive profitability, right? Like 200% gains on those oil stocks. Same thing here. I could double my money. And so just because you're in a volatile time does not mean it's a bad company. T. Rowe Price allocates capital very well. They've grown the dividend for over 25 years. They're a dividend aristocrat. They have plenty of cash flow to keep growing the business, and they make money off of fees and assets under management. And the fees are what compound and make them extra cash. So as long as their assets under management stay relatively positive and people aren't moving, if their returns and their funds are matching something like what Vanguard would do or Fidelity would do, and they're not losing huge amounts of clients or assets under management, you're going to be fine. So that's why it's important to understand. If you don't want to do the research and understand individual companies, buy the S&P. There's nothing wrong with buying the top 500 companies in the world or in the U.S. Not a huge there's no knock there. There's not a huge disadvantage. In fact, you'll probably outperform most investors. But if you understand individual companies and the economics behind them, and you can take advantage of the market misinterpreting news or overreacting to that news, then you can get really big gains. So AbbVie, for an example, real quick, AbbVie I bought when they were acquiring Allergan, which means they bought the company. AbbVie dropped like a rock. Allergan went up because they promised a certain price. AbbVie said we'll buy it for X amount, and the Allergan shareholders will get paid, say $20 per share, and we'll buy the company out. And we're going to do an all stock transaction. So all of your company is going to turn into AbbVie shares, and together the company will be worth X amount. Well, you bought AbbVie at 88, and Allergan was say 120. They come together, and I said that I thought that they were going to be worth like 150. So I think Allergan. I don't remember the exact prices. It's been like forever ago. It's like 5 years ago. But when I did the analysis, I said, they have these drugs. Like Allergan has these drugs, brings in this amount of money. AbbVie has these drugs, that brings in this amount of money. And I did like an estimate on what I thought where they would be with profits, even with Humira going. And I said roughly, without Humira, I said about 120. So even if I bought it at 88, I'd still have like a $50 upside, around $50 upside per share after that patent went away. Well, here we are, and I'm at 171. So that's really the main reason why you would pick individual stocks, is if you can hold during the bad news and differentiate a bad news story from a bad company. That's where you make the real money. So next, the watch list. I want to buy Berkshire, guys. I mean, honestly, I said like I'd have like $500 in dividends. I might just pull the trigger and buy some Berkshire, to be completely honest with you. But with that being said, guys, I just want to say thank you so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy. And when you do, make sure, guys, when you watch the videos, leave me a comment. You know, maybe there's a stock you guys don't like. Maybe you don't like Altria because it's a tobacco stock. Maybe, you know, you think it'd be better putting Amazon or something like that. Let me know. I love getting feedback. If there's a stock that kind of under the radar that you guys think it's a great company, let me know. I'm always down to do more research on companies. I have a very open mind when it comes to investing. So thank you guys so much for watching, and I'll see you guys tomorrow with another Robinhood portfolio update. Take care, guys.